Have you ever felt totally lost trying to figure out who actually has the power in the stock market? It can be super confusing, especially when it seems like the rules are stacked against you. Today, we're going to talk about the secret players who really control the game, the market makers. So, what are market makers? Essentially, they're the backbone of the stock market ecosystem, providing a vital service that allows you and me to buy and sell shares. Without them, trading would be slow, inefficient, and downright chaotic. When you place a trade, you're not directly interacting with another investor. Instead, you're dealing with a market maker who's acting as a middleman, providing liquidity to the market and facilitating the transaction. Their importance cannot be overstated. Without market makers, the entire system would grind to a halt. In fact, they're so crucial that regulators and exchanges have put in place strict rules to ensure they operate fairly and transparently. One of the primary functions of market makers is to provide liquidity. This means they're always ready to buy or sell a particular stock, which gives you and me the confidence to enter and exit trades quickly. Without liquidity, trading would be slow and unpredictable, making it tough to get in and out of positions. Another critical role of market makers is to reduce volatility. By constantly buying and selling, they help to smooth out price fluctuations, making it easier for investors to make informed decisions. This is especially important during times of high market stress, when emotions can run hot and impulsive decisions are made. Market makers also work to maintain orderly markets. They do this by quoting both buy and sell prices for a stock, even when there aren't any natural buyers or sellers. This helps to prevent wild price swings and ensures that trading remains relatively stable. In addition to these core functions, market makers also play a vital role in price discovery. By constantly updating their quotes, they help to reflect the true market value of a stock, giving investors a better sense of its worth. Let's take a real-life example to illustrate the impact of market makers. Remember the GameStop saga from a few years ago? When a bunch of retail investors banded together to take on the short sellers, market makers played a critical role in facilitating the massive trading volume. They were the ones providing liquidity, stabilizing the market, and helping to maintain order during that wild ride. Another example is during the 2020 pandemic, when markets were highly volatile. Market makers were instrumental in keeping the system running smoothly, providing a vital source of liquidity when investors were panicking. In the flash crash of 2010, market makers again played a crucial role, stepping in to provide liquidity and stabilize prices when the entire system was on the brink of collapse. However, there's a common criticism that market makers manipulate the market for their own benefit. While it's true that they do have significant influence, the reality is that they're subject to strict regulations and oversight. Their primary goal is to provide a fair and orderly market, not to line their own pockets. In conclusion, market makers are the unsung heroes of the stock market. They provide the vital functions that allow us to trade with confidence, and their importance cannot be overstated. While they do have significant influence, it's not about manipulating the market, it's about maintaining a fair and orderly system. So, what do you think about market makers? Do you see them as the good guys, or do you think they have too much power? Let us know in the comments below. And if you want to learn more about stock market strategies, be sure to check out our next video, where we'll dive into the world of technical analysis.